Good. Well, thank you, Declan, and good morning, everybody. I'm very glad to have an opportunity to speak at the beginning of your conference. You'll be glad, I suspect, to hear that I'm not going to talk to you about the John Lewis economy. Intriguing though that might be, I think I'll leave that to others to comment on today. Now, I'm going to echo a couple of things that I think George and Declan have touched on. But you probably don't need telling, but the last 12 months have undoubtedly been the toughest since the beginning of the recession for the consumer part of our economy. And that has affected both the non-food sector and indeed the grocery and the food sector in equal measure. And if you feel perhaps that you're still facing the wall and still things are pretty tough, or maybe you're just beginning to feel like you're climbing to the top of the wall and beginning to look across to the other side, I actually think that this conference is particularly well timed, and it's particularly important to take a bit of time out to reflect on what is going on and to consider what that means for the future. The fact is, we in the UK retail market conduct our craft in what is undoubtedly one of the most competitive and developed retail markets in the world. That makes it extremely challenging. It makes it very challenging for some of the retailers who try to enter the UK retail market, but it is also what makes us as good as we are. And I think we're very fortunate in the UK to have some of the best retailers in the world. But I say that without a shred of complacency, because I also believe that we are looking at some profound changes taking place in the retail market at the moment. And really, I wanted to talk a bit about those and then to share with you some thoughts about some of the implications and how we might respond to those. I don't have very many charts for you today. In fact, I only have one. I'll flick forward for a couple, but only have one, which is a chart which, it's a graph which appeared in the FT in January. And what it shows is the proportion, there we are, the proportion of the FTSE index that was, it's, if you like, the market share of retail as a proportion of the value of the FTSE index. And it goes back from 1992 and then goes all the way forward to 2012. And this is really for the general retailers, which is the non-food side of the retail market. And it shows, I think, quite a stark picture. What it says is that actually back in the early 90s, retail commanded about a 6% share of the total index, of the value of the total index. By 2012, that share had shrunk to slightly less than 1.5 percentage points. Now, of course, in between those two points in time, a lot has happened. Obviously, some retailers have left the market, some have gone private and therefore are no longer in that market. But none of those things account for a fall as dramatic as the one you can see here. And it's not just restricted to the general retail market. Actually, since 2007, the value of grocers on the stock market has dropped by about 30%. So what is this telling us? Well, I think what it's telling us is that the market is actually placing less value on retail within the value chain that we all live in, from primary production through to consumption, than it used to. That's basically what this is telling us. And I remember when I first came into the retail market from Lucozade, as Declan said, and I remember being struck by something pretty powerfully, which is that, my goodness, you have to work very hard. We have to work very hard to make our money. I won't embarrass SmithKline Beecham, or now GlaxoSmithKline, by telling you what the margins were on Lucozade, but I can tell you they were pretty healthy. And when I first came into retail, I thought, gosh, we make a lot. We have very high sales, but our margins are pretty thin. And another example I would just cite is the comparison of Apple and Tesco. Apple has a market cap, as I'm sure you've been reading in your papers, of about $540 billion. If you do the conversion for Tesco's market cap, it's about $50 billion. But in some ways, that comparison, I think, is not the most interesting one, because obviously market values go up and they go down, and they're obviously volatile. What's more interesting is that the operating margin of Apple is about 34%. The operating margin of Tesco, I'm not sure, actually, Richard Brasher later will, I'm sure, will be able to tell you precisely, but probably around 6% or thereabouts. And of course, that is actually what accounts for the very large difference in the valuations between one of the largest retail businesses, let alone in this country, but in the world, and the largest company in the world by market valuation. And of course, Apple achieved that by selling something like only about 9 products. But of course also selling a lot of content where I imagine that the gross margin is almost infinite. And of course, because of all those dynamics, Apple is able to invest something in the order of $2 billion a year just in R&D to maintain the technology and the functionality and the design that has been the cornerstone of the success of that organization. And so my point really is that we in retail have always had to work hard to make our money, and we will continue to do so probably because we have a lower margin kind of business. But it's important to realize that the industry is changing around us. We're facing a different economic outlook. We are facing different competition. And actually, we're also facing different dynamics in how money is made in the retail market. And against all of that, I think now is a very important time, therefore, to reflect on how we create value in the retail market. The stock market is pricing in some of the changes that I've described, and indeed they're not new because, as you could see from the chart I showed you, this has been happening now for some time. But what it is not pricing in, I believe, is the opportunity that exists for retailers who really see how that market is changing and embrace that and move towards it with real determination, verve, and vigor. So let's just look at a few areas, and I hope at the beginning of your conference today you'll accept a degree of provocation in what I'm going to say. What I notice in the agenda is that pretty much everything I'm going to talk about is going to be developed, expanded on, or addressed by speakers who are going to be talking over the next couple of days, and I'm sure that they will have fascinating insights, and they'll really add to the collective opportunity we've got to think about the future of the retail sector. And as I said at the beginning, I can think of no more important time for us to take that opportunity. So first up then is good old consumption. And obviously consumption is down. It's quite tempting to think that that is because of the recession, because of a cyclical step down in people's disposable income, and the consequences that has obviously had for consumption, and that as with all cycles, it will then rebound and it will go back up to a level that we enjoyed prior to the recession. I don't think that is going to happen, because I think we're moving actually into a different phase for our economy. And it's very important that we understand what has changed. And fundamentally, it comes down to 2 things: credit and deflation. Now, if you look at credit, and credit and deflation basically fueled what was an extraordinary boom in consumption prior to 2007. Now, on credit, I probably don't have to say an awful lot about that, because you will well know the state of the banking market and the state of credit and availability and the cost of that, not only to businesses but to individual consumers. What you may not have realized, though, is the extent to which households took on credit, took on debt, if you like, in the 10 years prior to 2007. There are lots of numbers out there in the market, and what they show is that the average UK household took on something in the order of 10 times the debt that was taken on in many other developed economies. And it was probably going to take something in the order of 10 years for that debt burden to unwind fully to get back to a sensible level. And clearly we're probably 2 or 3 years into that cycle, but we are certainly nowhere near the end of it, and there is a lot further to go. So that has changed in terms of one of the drivers that fueled consumption before. It's not going to be there as powerfully going forward. The second area is deflation, and I think this is a very important one. In 1970, a pair of Gap jeans probably cost you about 28 quid. In 2000, they probably cost you about 28 quid. And in 2012, they probably cost you about 28 quid. If I'm honest, I don't actually know what Gap jeans cost, but I'm guessing that it was something in that order. And of course, in between those periods of time, what we've all seen is our disposable income has increased enormously, actually by around 4 times. And so in effect, an item like that became, in effect, 4 times more affordable during that time period. And not surprisingly, that meant that we were able to buy an awful lot more items, and that fueled consumption. it was possible because at that time, through a lot of that period, the developing economies were focusing on developing their economies by producing goods for consumption in developed economies. That is fundamentally changing. And I was in China towards the end of last year, and again, many of you who probably have been there or been reading about developments there will notice there's been a very important shift in the Chinese government policy towards recognizing the importance of stimulating domestic consumption. And something that I was talking to people about there last year is that the five-year plan, it plans for the national minimum wage to increase, not by sort of 2 or 3 or 4 or 5% each year, actually by over 15% per year, expressly to double that national minimum wage over a period of 5 years, with the express intention of stimulating domestic consumption. And of course, what that will do is change the dynamics in terms of supply and demand. And I was also in South Africa right at the end of last year talking to some Waitrose growers. And what I found very interesting is they were beginning to tell me that actually they were probably negotiating a little bit, I suspect, but they were telling me that there were customers approaching them from Asia who were asking them to supply produce which sometimes was at a lower specification than what we required for Waitrose, at either the same price or even occasionally a higher price. And I suppose the point I draw out from that is that globalization is not something that just happens when we open a shop, or is not something that happens when we start sourcing from a particular market. Actually, it's happening right now in the sense that we are already competing directly with some of these markets, and we will feel those effects increasingly. So what does this mean then for retail generally? Well, in some ways, it means that we need to do more of some of the best things that we already do in some of our retailers do. In a world where pretty much anything that can be bought online will be bought online, it can never have been more important to be able to develop and source products which are what your customers really want, and they can only buy from you. That capability has never, I believe, been more important than it is today. And indeed, many successful retailers have become skilled at this, and their success depends on that ability. And so while the ability to originate and source unique and valuable product has been important for many, actually my belief is it's going to become vital for many more in the future. And of course, what we're seeing when you look around, indeed, in some of the statements that we've seen in recent weeks, is a resurgence as a result in terms of the importance of UK sourcing, a resurgence in terms of an interest in vertical integration, and a renewal of a recognition of the very great importance of creativity, of design and innovation for success in retail. And I believe that the retailers who really make a point of developing those capabilities will end up with a distinct advantage over the retailers who do not, who may well find that what they're having to do is compete in a market which is increasingly commoditized by the ability of customers to shop pretty much anywhere and any time they want. Second area I want to talk about is technology. And again, you're going to be hearing a lot about that. It's right through the whole agenda. But I think the observation I'd make is that for quite a lot of people still think about technology in retail terms as how much gets sold online. And for my view is that technology is much, much, much more than that in retail. Actually, it's about how it is changing the way that customers shop, and indeed redefining some pretty basic behaviours, such as what convenience really means. And in so doing, it's actually challenging some of the core shopping behaviours that have underscored some of the most significant developments in the landscape of retail over the last 30 years. If you think about the hypermarket, it's probably one of the most significant developments in the last 30 years. That has come about because customers were doing their weekly grocery shop. It became convenient for those customers, and indeed profitable for retailers, to offer them an increasing range of non-food items to go alongside that weekly grocery shop. And of course, the opportunity was there to put that non-food product offer into space which was on a marginal basis relatively cheap by comparison with new space. It was possible to use logistics chains and operational efficiencies to be able to retail that at a relatively low cost, and therefore to offer the customer not only a convenient choice, but one that was pretty well priced and attractive too. But what if the customer then now has an infinite choice, where they aren't restricted just to buying what's available to them in their local hypermarket, where they can actually get more price reassurance, they can get more information about what they're buying, and they have an pretty much unlimited choice to do so. And with the development of fulfillment networks and practices, actually they can get access to that product really quite conveniently. It does change fundamentally, I believe, some of the commercial rationale that's underscored that very significant development. Take another market, a fashion chain launching in the UK maybe 10 years ago or 15 years ago. You would probably, if you wanted to have a UK presence, you'd probably be looking for something in the order of 200 or 250 shops across the UK. Now, if you were launching a fashion chain in the UK, you'd probably be looking for something like 60 or 70 shops. So it's no surprise then that, taking those various points into account, that there's so much speculation around now about the slackening in demand for retail space, indeed a retrenchment in demand for retail space. It's no surprise that there's growing concern about the space bubble that I genuinely believe is developing, particularly in the grocery sector, where there's been a 50% increase in space that has been granted planning permission since 2008 versus a relatively flat picture prior to that, while there was a lot of consolidation going on in the sector. And indeed, my view is that some of these impacts have probably been understated, and certainly they will be felt unevenly across the market that they affect. So there's some significant challenges for retailers across the land responding to those things. But actually, the impact of technology is even more fundamental than that. All businesses have fixed and variable costs, but as retailers, actually, we've had a bit of a leaning traditionally towards fixed costs. If you think about it, we build shops, we spend money on fixtures, we commit sometimes for decades to pay rent, and of course, having done all those things, we very sensibly then try and get as many customers into those shops as possible to cover those fixed costs, and we've become very skilled at doing that. We're very adept at finding ways to draw people in, and the more we do so, the more we cover the fixed costs, the more cash we generate, and the more profitable and the better the returns are. But what if the customer starts to behave differently? What if the customer actually starts to become more fickle? What if the customer actually finds that they don't need to visit quite as often as they used to? What if when the customer does visit, they do so for a much more specific reason, perhaps, than they had previously? And what if technology creates a transparency in a market, which means that margins are squeezed and that the ability to sustain a premium on a product is reduced? Those things change, I believe, really very significantly, some of the dynamics. And of course, they are happening now. But if you think about opening a new shop, let's say we open a new shop and we spend, and I'm not talking about the partnership, but a retailer spends £5 to £10 million on opening a new shop. You put that money down and you obviously do the best you possibly can to make that look as good as it possibly can. You put that shop there to serve 100% of the customers that might shop in it. But if you think about some of the behaviours that I've described to you in terms of the customer changing their behaviour, the likelihood is that, in fact, instead of 100% of those customers providing you with the return, in fact, you're likely to become increasingly reliant on a proportion, let's say 20% of those customers. And one of the things I'd encourage you to do is look at what your 80-20 ratio is in your business. If you haven't done that, have a look and see how many customers drive 80% of your sales. And I think what you will find, certainly if your experience is anything like ours, is that you have in fact already got a very strong reliance on a subset, and perhaps an even more concentrated subset than that traditional 80-20 would suggest, on a smaller group of customers. Look also at how many of those customers, those 20%, shop across channels. And again, if your experience is anything like ours in the partnership, what you will find is that a very high proportion of those most important customers shop across channels. And of course, this is going to change, I believe, very significantly the way that money is made in the retail sector. It's not just going to be a question of casting the net wide, putting the shop down, welcoming lots and lots of customers in, and generating a return when we cover all those fixed costs. Actually, the best customers, the most valuable customers, I should say, shop across all of those channels. And of course, the dynamics between a shop and an online business are very, very different. One has high fixed costs, the other has high variable costs. And so my point is that, that technology doesn't just affect how people shop and indeed have implications for the requirements of space. It actually has fundamental implications for how money is going to be made in the future in retail. It's not just going to be a question of return on assets being a function of how many customers come through the door. Instead, we're going to need to look increasingly at customer profitability. And where we do that well, then I think we'll find that we get some very healthy returns from the assets. Where we don't, you may well find that your FD will be saying to you, not asking you how much of a return can you get on the asset, but when can you return the asset to somebody else. The third area I want to touch on is brands, and actually specifically retail brands. And in a way, this sort of follows on from what I've been saying, because I think it's one of the ways we achieve a greater focus on customer profitability. One of the effects of technology is that information is pretty much ubiquitous now. Product availability is very broadly available. Choice has actually exploded for many customers, and actually the ability for customer-to-customer communication has expanded enormously. But in amongst all of that, what's actually emerged is the power of that human desire for belonging and association. If you look at what's happened with social media, the extraordinary success of social media, probably the single greatest use of technology of all of them is in fact that, reflecting customers' desire, consumers' desire, people's desire for belonging and association. And against that backdrop, there is an enormous opportunity for brands which are appealing, which are authentic, and which are trustworthy, and which say something powerful and important about you as an individual. And of course, it's hard to create all of those characteristics in a brand. It requires increasing, and particularly perhaps in this environment which is so transparent, it requires real consistency in terms of the experience that people get of shopping with that brand or interacting with it. It requires those brand values to be reinforced at every single turn and every single opportunity. And of course, it relies on the social aspects of the brand in the sense that it's not so much what you say about your own brand, it's actually what other people say about your brand to their friends and their colleagues, which matters so much. And of course, the value against that backdrop of doing that well and having a really powerful brand, I think has never, ever been greater. Clearly, it's never, ever been more possible to lose that value as quickly if it goes wrong and goes in the other way. But it's not easy for retailers to really adopt that brand thinking. And if you think about the tools of our trade, we are steeped in the language of sales density, of operating margin, of service metrics, of operating efficiency, and of customer satisfaction. But in a brand world, we talk about values, we talk about relationships, and we talk about reputation and image, we talk about experience. And of course, in a brand world, success is measured, not so much actually necessarily in like-for-like sales or operating margin, although those are very, very possibly the key outcomes, but in terms of the number of customers who use your brand, the strength of their association with your brand, and indeed the value that you derive from that association with your brand. And in retail, we tend to use proxies for that in the form, as I've said, of like-for-like sales and of operating margin. But in my belief, those proxies are likely not to be enough in the future. We're not all going to suddenly become lovies and brand folks necessarily. But the value in authentic brands is enormous. And in order to maximize the value that we can create in retail, we need to be thinking not just as retailers, but as retail brands. So to conclude then, it's not a normal recession. I don't believe that we're going to see everything come right through the cyclical recovery, even though my view is that things will improve in the course of this year. The market is, I believe, changing in a profound and fundamental way, and the key thing is that we recognize that and respond to it. It's a bit like approaching this market as if we're sort of driving around the M25. When you do that, it sort of feels like you're traveling, but if you stay on the M25, after a while you end up focusing on the traffic. You probably get stuck in some congestion from time to time. And instead, what we need to be doing is looking up, seeing the signs that there are some fundamental changes taking place in our industry, and actually taking the turn-off which leads to the open road. And on that open road, it's going to be about product design and sourcing and the ability to originate products. It's going to be moving away from focusing a lot on volume and price to moving towards focusing on value add for a price. It's going to be about focusing more on customer profitability and the importance of understanding those customer dynamics. And as I've mentioned at the end, really recognizing the potential value there is in retail brands. And if we can do all of that and we approach our industry in that way, I'm convinced that we have the capability in what is undoubtedly one of the best performing and best retail markets in the world to perform extremely well. And I hope that you have an extremely good conference. A lot of the speakers are going to be talking about exactly some of these issues. And I hope that over the next 2 days, it's both stimulating and thought-provoking in terms of how we might go about developing all of this. Thank you.
Charlie, thank you very much. RWC 2012 is the hashtag if you are making your comments on Twitter. Quite a few people on Twitter have already picked up on your comments about a property space bubble developing on the high street. Say some more about that.
Yeah, I think there are lots of forecasts that the demand for space on the high street is going to be down by about 30% by 2020. And I think we're already seeing some of the early signs of that with some of the vacancy rates that are taking place. And unfortunately, my view is that those may persist and increase. But then add to that the fact that you've also got this very significant increase in the amount of space that is planned to open, particularly in the grocery sector, over the next few years. What happened in this market is there was a period of consolidation when, in fact, because of the mergers that were taking place, and particularly in the grocery sector, there was a lot of expansion for the existing players from absorbing and converting some of the space that they had acquired into their new fascias and their new brands. As that has ebbed away and we've moved out of that period of consolidation, actually what we're finding is people are still focused on trying to drive growth and drive growth through space. And the simple fact of the matter is, if you look at how much space is planned to open in the grocery sector over the next period, you'd need to see an increase in consumption of something in the order of £20 billion in order for that space to achieve a similar sales density to what it achieves now. And I can't see that kind of increase in consumption taking place. So it must put real pressure on the ability to drive the same sales densities and therefore, of course, the same returns from the space that is planned for development.
What has that thinking done to John Lewis's own plans for expansion? Because at one stage they were on the aggressive side. Are they now being reconsidered?
So we've adapted our plans somewhat. So in John Lewis, for example, 5 years ago we were probably looking at opportunities for maybe 10 or 15 full-line department stores. Now that's probably more in the order of 5 or 6. But in its place, we see the need still for expansion for John Lewis. I think that we have 35 John Lewis shops, and compared to some of our competitors who've got well over 100, in some cases many hundreds, that is relatively few. And there are many places where we don't have a shop. So I think that for John Lewis, the opportunity is for us to have 50 or 60 shops across the UK. They may be of a different format and different sizes to the ones that you see today, and indeed we're opening a new flexible format in Exeter this year, which will be very interesting. And then for Waitrose, we have 275 shops, and again, that is relatively small by comparison to many of our competitors. And there are very large parts, something like 40% of customers who would like to shop in Waitrose can't because we don't have a shop close enough to them. So we continue to actually see for us opportunities to expand both Waitrose and John Lewis because of the current store base and the fact that a lot of our customers are outside of our reach of some of those of our current catchments.
So it is something you can take advantage of rather than something to cause a retreat.
We think so, yeah.
Okay. We've time for one or two more if we have them. With all the Q&A sessions today, if you want to ask a question, then raise your hand, and you'll need to wave it about a bit so I can see it because the lights are a little bit dark in the room. Wait for the microphone to reach you. When it does, then tell us who you are and what organisation you are from. It may just be my failing eyesight, but I'm not seeing
I can't see anybody
many
waving at
hands at all. There's one right there. If you just wait for the microphone to reach you, keep standing where you are, and someone will... There we are. I can see 3 or 4 people racing towards you now. And we have a winner.
Hi, I'm Natasha Tutel from Visa Europe. Charlie, just to say thanks very much. Great opening sort of session. Obviously, I'm quite interested in what you guys, across the whole retail environment, are sort of doing in the payment space. You know, we've seen more coming into contactless, we've seen more technology coming into mobile and more on e-com. Really, sort of, what do you think? I think mobile sort of offers the biggest sort of excitement with regards to Visa to payments. Just be interested to what you see as from a retailer as to what mobile brings to you in that new sort of payment ecosphere.
Okay, thank you.
I mean, I think I defer to your expertise on exactly what the capability will be. But I'm sure that mobile payments and integration with PDAs and mobile phones, etc., will become absolutely critical to the area of payment. But I think the most interesting thing about it for me is the application of that. And if I go back to what I was saying about a customer-centric approach and one that focuses on customer profitability, it's all about how you can use all the technology available, including payment, including how you interact with customers, to maximize that. And I think what's quite interesting is as payment moves from being a plastic card in somebody's wallet or their purse and into a personal device of some form in terms of an iPhone or a BlackBerry or a mobile phone, actually it seems to me that the opportunities for that to become part of a suite of things which allow you to relate to the customer simply grows.
Okay, thank you. There's one right at the back.
Thanks. My name is Kebi Sebastian. I'm with Penser Consulting. You spoke about the 80-20 rule and the need to monitor and manage customer-level profitability. Can you speak to how you're building your own internal analytics capabilities or loyalty capabilities so that you are at the cutting edge of managing that?
Yeah, so we're increasing our investment pretty dramatically in this area. But honestly, my view is that we're probably, still not investing enough, and that we'll be investing more in the future. Probably good news to yourselves and others in your world. But we are completely overhauling our approach to both gathering data. There's an extraordinary amount of data in our business, and increasingly so at a customer level. And so the first base is to make sure we're collecting all of that in one place, in a consistent way, and all the channels lead to one place, and then building the capability there so we can start using it to increasing effect. We're already doing quite a lot of this. So, and indeed, what's fascinating about the whole cross-channel, multi-channel world is you see connections that perhaps were difficult to see previously. And the more you look, actually, the more opportunity you can find.
Just looking at the performance of the partnership overall, it seems to be a little bit along the lines of that your online business is doing terrifically, but the shops seem a little bit stuck.
Well, no. I would say what is certainly happening is you're seeing different things happening across the two channels, and it is the case that our profits are growing. On the face of it, you'd say if you look at it as sort of channel basis, you'd say yes, sales are rising online and they're flat to stable to slightly down in shops. Profits are massively up online and they're down more in shops. Now, in John Lewis, that happens in the cycle that we're in because we sell largely items which are discretionary purchases, and that is what goes on. But actually, taking that channel view misses the point, because it is the same customer that's shopping across both of these channels. And so it is exactly my point that actually we have to focus today not on how we maximize the profit of each individual channel, but in terms of how we maximize the profit to that customer. And so, the biggest mistake we might make, for example, would be to say, well, actually what we need to do is cut the costs dramatically in our shops in order to preserve the profitability of that channel. And in so doing, probably fail to understand the importance of that channel in driving the overall customer behavior, customer shopping, sales and profitability. And what we know, and I'm sure this will be very much the same for many of you here, is that where you have a customer who shops just in one channel, say in the shops, they spend X. Where they shop in two channels, they spend X plus a lot. where they shop in 3 channels and indeed across brands, and in our case across Waitrose and John Lewis, they spend X times many, many times. And so, the whole point is not to look necessarily at the profitability or the sales in each channel, it's actually to look at the totality. And, there's no question that where we are as a business is we're looking at some of the things that I've been describing to you and making some significant investments now so that we are preparing to move into that space and understand how we can succeed in that way. And some of that's costly and some of it has an impact on short-term profit. But again, we're prioritising that longer-term picture over that short-term outcome.
Just one last thought from you before we go to the Enterprise Minister. You're chair of the Commission on Employment and Skills. What did you make of the fuss over work placements?
So I thought that was, I'll be very blunt about it, I thought it was opportunism from some commentators. Essentially, I think it was retailers trying to make a real difference. And really trying to help people who are in long-term unemployment. And I've every sympathy with the people who were saying, look, the most unfair thing is for someone not to have a job at all. Giving people an opportunity to get experience, which allows them to get into work, or gives them a better chance of doing so, must be a good thing. And to focus on the fact that there may have been a few small abuses, I firmly believe that they would be a very, very small minority. Was really missing the point. And it's a great shame that happened, because I think what would be very sad is if businesses were put off from doing good things to help people into work. I think that's a very important contribution that business needs to make to society, and particularly now.
And those retailers which did pull out of the scheme after there was a little bit of media pressure, were they gutless cowards?
I don't think they were gutless cowards, because I'm sure what they would say, and actually the partnership didn't participate in these schemes at all, so we didn't get into it. But the reason we didn't do that is because we already employ a lot of young people. We already actually are constantly recruiting and employing people and bringing people in on work experience, so we didn't feel the need to join that scheme as such. And I'm absolutely confident that for any retailer that decided to withdraw from the scheme, they didn't withdraw from the notion that they should be providing quality work experience to people to get into employment. They simply said, we're going to do this in a way which actually avoids some of the reputational damage that they've probably unfairly incurred as a consequence of joining the scheme. But I don't think the intention or their commitment was any less as a result. And in fact, some of the people who didn't join it, and indeed some of the people who withdrew it, made that exact point.
Ladies and gentlemen, Charlie Mayfield, thank you very much.